All right, guys, what we're going to have a look at now is support and resistance. And throughout this whole section, it's not about saying, all right, look, there's an obvious support and there's an obvious resistance derived from a previous day's low or previous day's high or any kind of indicator that derives that. What we want to focus on here is understanding how these are created, why a market has stopped at a certain point, why it has turned here, why it has turned there, and what exactly has happened. Because in understanding what's happened, you can then understand what is likely to happen on a future test of that area, how you can expect the market to trade. We're going to look as well at when's a level strong, when's a level weak, because that's the kind of thing that you need to be able to differentiate. And this all comes down to, again, recognizing how they've been created. That way, and this is so important, whenever you're thinking about support and resistance, it's not about developing a strategy that every time you hit a resistance, you sell and expect to take a few ticks out of it. It's about having a way of differentiating whether you think this level is going to break or whether it's going to hold, and then deciding what you're going to do in a trade based on that. So what I'm trying to get at here is that if you're about to take a trade on, or markets are approaching a level, you need to have decided before you get there. Let's say you're approaching a resistance. You've got to decide before you get there, are you going to sell that or are you going to buy through it? And so your decision is not when it gets there, will I, won't I sell it? Or will I, won't I buy it? It's, I'm going to buy this. And then it's a case of looking for the right type of action that says, yes, you can buy it. And that all comes in down to the way the level is approached, how you get there, and the interaction that happens at the level. So let's start off. We'll talk a little bit about defining and identifying levels. And this is all about an auctioning process. So think about what happens as you reach a level. I'll try and talk you through this in sort of 5 stages, if you will. Now, to start with, any kind of move higher requires more buyers than sellers. Essentially, buyers overwhelm sellers. They are more willing to pay higher prices. So anybody who wants to sell, a buyer comes in and says, yep, I'll buy that off you. This then pushes prices higher. Now, as prices higher, and this is where the auctioning process comes in, or the idea, the concept of an auction comes in. You think about any auction, as price rises, less and less people participate. There's a less willingness to buy, for obvious reason that prices continue to move higher. And so those who were looking to buy to sell at a slightly higher price stop seeing the value in that. Those who wanted to buy because they thought this was good value, well, that price going higher suggests that this is perhaps no longer such good value. And that's then what influences the willingness of buyers to transact. Up until a point. And at point 3, what starts to happen here is this becomes the end of a move. And if you think about what's happening, this is actually, for a very small moment, the point where the market stops. Because what's actually happening here is you've completely run out of buyers. There are no buyers who want to come in at these prices because prices have risen too far, if you will. But equally, sellers now are unable to sell. Why? Because nobody's going to come and buy from them. So now you will have people sitting here thinking, I'm going to sell, but nobody comes and buys. You can't sell something to somebody if they're not willing to buy it off you for that price. As a result, sellers now need to move their orders lower. They need to go and sell it to the people willing to buy. And this is what now creates a situation where selling comes in. As now it's a situation where you've got people selling because they think this is a good price to sell at. You've also got buyers who have been buying it up here, and particularly the buyers at number 2, who have followed this up as the move's gone on, become the last people in the auction. As this has now happened, they're trapped. They now also become sellers, and this is what perpetuates the move to the downside. But as the move drops further, you're going to run out of those sellers. You're going to run out of people exiting long positions. You're going to run out of people who still think that this is good to sell. And this is then what slows the move down again. That's the kind of auctioning process that creates levels. You will get a new point here where, again, this balance shifts. You run out of sellers, and we find that actually there's enough buyers here to stop the move. You can't find as many sellers. Buyers no longer can get filled here, and they will then have to move their bids up in order to get filled, in order to buy. So that ultimately is how the level gets created. It's a momentary stop in trade, ultimately. People are not willing to pay these higher prices. People who want to sell cannot sell because no one's going to buy from them. And as such, you get this balance shift from people willing to pay higher and higher prices to sellers willing to sell lower and lower prices. So that's how a level gets created. You often hear some reasonably simple phrases when it comes down to support and resistance. Things like large time frames produce better levels. Now that's an entirely subjective thing. And there is an element of truth in this, but you have to think about why. The element of truth in this is that people of all time frames are going to be more aware of larger levels. So you think about the different participants in a market. Think about what we talked about with futures and options. People have different motivations to trade. Now, daily levels, for example, short-term traders are very aware of them, but longer time frame traders are also, whereas longer time frame traders are not that fussed or aware of 1 minute, 5 minute levels. So there is some credence in this assertion. The problem is, larger time frame participants also aren't price specific. So they don't mind in being able to say that actually their level is perhaps anywhere between these two red lines. And so yes, it may well be a stronger level, but it also has much greater variance of prices. And we'll cover this a little bit more when we look at when exactly is a level broken and trying to determine that. So time frame does matter. The reaction that you get, the ability of a market to completely turn and completely change direction is going to be more dictated by larger time frame levels. Whereas between those larger time frame levels, you will get shorter time frame movements. And this is the point, that ultimately all levels and all movements are fractal. That within what could be termed as a wider move up and move down, you can see that we've already got multiple smaller movements within this. But within, say, this move here, you may well have also had a drop and a pullback and a drop and a pullback and perhaps a small touch up twice on this level. And within any of these moves, you would have smaller moves. So yes, the larger directional turn is going to be more dictated by a larger time frame, but it doesn't mean that there aren't short-term patterns and short-term supports, resistances within those larger time frames. There could be 2 days worth of trade here that provides multiple short-term opportunities without overall changing the direction of the market. This is why it's so important to be aware of both the longer term and the shorter term context within which you are trading. So now you got a sense as to the importance of time frame. I'll give you a couple of examples of this in a moment. When we look at examples, we'll move through 60-minute examples, 5-minute charts, daily charts, and look at the interaction between them. And what you will see is that patterns, particularly when we look at chart patterns, are all the same. They work, and the methodology and concept of chart patterns are the same, no matter the time frame. So where are your levels going to come from? How are you going to spot these? Because unless you're seeing the action taking place here, so the first creation of the level, you're going to need to use previous points as references to define whether you think there is a level there. Now, the obvious one is an extreme of a move. So most recent swing high, swing low. Nice and simple. That's going to be a daily high or a daily low. It's a single point where the market's traded down to and bounce back away from. You will also get what I call a switch point. And what you've got to think about here is this is a slightly more nuanced version of the market changing direction. When you have an extreme of move, this is simply a point where the market's moved down, hit a point, you've got that shift of power, essentially, that we talked about on the previous slide, shift of power back up. Now, you can also have a situation where you within that have a shift of power one way, that is sustained, and then that broken back. And I'll give you an example of this, because to try and explain it without showing is slightly difficult. Another area that people don't consider, and perhaps the final two are the two that don't get noticed very often. Initiation candles. Again, going on the basis of balance and market shifting from buyers in control to sellers in control. Initiation candles are the start of these moves. Typically, when you look for a level, people look for where a direction has ended and turned, rather than looking at where a direction has begun from. And that's what I mean by an initiation candle. So we'll go and look at those, the sort of extreme movement that you see or change in the way the market's trading. Those points where buyers or sellers take control often will then produce a support or resistance. And it's a much, much less obvious point to be looking for than the much more obvious extreme of move. The final thing as well, don't dismiss a level just because it's broken. And this goes back and links back to the switching points, that markets will often pivot around levels. And this comes back to that idea of things being fractal. That yes, you may see it as a support or resistance, but for many others, they will see it as the middle of a range. And with every range, and we'll talk more about ranges when we look at chart patterns, with every range, there is then also, excuse me, with every range, there is then also a pivot area in the middle, an area where the market constantly bounces up and down to or up and down from. And that creates an additional level, one that is generally not noticed so much, but is more a point that can be targeted as opposed to used as a point to play away from. Prime example of why you can't just look at a level and assume it is supportive or resistive every time you reach it. So keep this in mind. It's ultimately a point where balance is shifted. And this point where balance is shifted either creates an initiative move or a reversal type of movement. Let's go and have a look at a few different examples. I'll bring in a few different examples to explain different concepts and look at different ways that supports and resistance get created. Okay, so what we'll look at to start with is the difference between a daily level and a 60-minute level. Now what we've got here is a daily chart on the left, 60-minute on the right, a set of lows. And these are in the euro. These come in at 120, 59, 67, and 69. So 10 ticks between them all. This is shown up just in here. So this little blue box here, the upper blue box, covers these three lows. Now, from the point of a daily, these are significant lows. As such, when they break, this brings in extra selling. People who are long above here get forced out. People who are looking at this as a sell are then going to initiate trade. So you get sellers coming in, the balance shifts. And this is what creates this quick sweep down. You take out all three of those levels in one. Nice quick move. Now, what you've got to think about here, from a short time trader's perspective, this is great. Level's gone, move is on. And we can now start looking down towards this previous high, down at 17. But you see here, from a daily candle, this looks like a nice clean dip straight down to the level, where in fact, you've actually got this waving type move. Gives you actually multiple opportunities, or two opportunities, to sell those 59s. And this is what I mean by understanding the difference between the dailies and the hours. You can use anywhere between 69 and 59 as a chance to sell. Just there, you can sell 59, you get a break of low, you can sell 59 again, you get the move down towards 17, which is that previous daily high. But think about this from the point of view of a longer time frame participant. They're going to be looking at this and thinking, well, we had highs before this little spike up here. And this is now an opportunity where we can buy. You can buy anywhere in this area, and that's this larger box to the downside. They're going to view this whole area, which essentially runs from 120.15 all the way down to 119.65. So 50 ticks worth of movement as an opportunity to buy. And as such, you will get movement, and you get entirely tradable movement within the day. There's nothing to be sniffed at on a nice clean 50 tick move down. But still, this is going to be a situation where larger time frame participants are going to view this as an opportunity to buy. They can still come in, they can still buy it all the way down here, maintaining that support. And once you then get all the way back up, we get the resistance at 69 once more. That's this little tick higher there, which gives you another little reaction. But this time, think about it. You can't see it on the hourly, but now that we've traded down and buyers have stayed in control, you've now got the scope of this level to break once more. Inability to maintain the move to the downside because of the fact that from a larger time frame, this is what I mean by large time frame levels being better, or that's why people will say that, is that this large time frame level ultimately has held. Yes, it's deviated 50 ticks through the extreme high, but you've not managed to break this whole range. And this is a concept we'll talk about a bit more as we go through. But levels are as much a range as they are a single price. You get a drop down. Once you're back up, excuse me, above 17, this move is negated, and this then tips the balance of power back into the buyer's hands, which is what then allows this move up. But don't get me wrong, you have 3 days of being able to use these previous daily lows as a resistance, and 3 days where you can use these two daily highs as support and trade within that. It's about understanding what you're trading within as opposed to trying to trade absolutes in terms of levels. Let's move on then. We're going to look at switch level. And this explains why markets don't necessarily always have to stop at the same point they previously stopped at. And think about this in terms of participants' ability to maintain a move and the point where they give this up. And that's the key to these types of trades. So what's going on here then? And we'll look at the first one, for example. We'll come back to this in terms of how 2 weeks later, in fact 3 weeks later, it provides a strong area of support. We'll come back to this in a moment. But think about what exactly is happening here. Think about that concept that I talked about of a market that runs out of sellers and will then find buyers. Now, this doesn't have to happen in an absolute straight V-shaped move like this. So what's happening down here, and this is on an hourly chart, what's going on there is you've had a market that's selling off, reasonably clear, sell off, market moves down. What then happens is you have a whole day's trade in this little box down here. This is two directional. This is not sellers maintaining the strength of movement that they've shown here, maintaining that push to the downside. But what you can see from this is a clear area where sellers are preventing the market bouncing from. Top of the box. What you're not seeing though is the ability of sellers to keep this move going down. So you are seeing that sellers are running out, but they've not entirely run out because they're able to hold the market low. This is what you're trying to infer from any kind of chart pattern. So we will then, out of this area, and this doesn't have to happen every time, you could see continuation, of course, but this is the point, that this now shows you where that balance has shifted. The quick move to the upside indicates that sellers are no longer in control. The balance has shifted. Buyers have been able to push back on sellers who have been putting a lot of weight on this market. They've pushed back, driven the market up. So this now changes the perspective. But the important bit here with this switch level idea is that buyers didn't become in control here. Down here, there was a balance. Sellers weren't strong enough to keep the move going down. Buyers were able to buy. And they don't need to push the market up. If you want to buy something cheaply and people are willing to come and sell it to you, you're not going to offer to pay a higher price. You will keep on buying it at those lower prices. But once price starts to rise, buyers have to change their perspective. And this is where buyers now become much more active. They take control and they start to pay higher and higher prices. This is what pushes the market up. And results in this continuation move up. But look at what happens again. Same principle, and this is where we see the switch come much quicker. Up towards highs, we create a high, just here, this little spike up, pull back, we break the high. Up here, buyers, like sellers down here, can't continue the move. They'll use previous high as a support area, which you can see just there, and they will hold and hold. And remember, this is on an hourly, so there's sort of 5 or 6, 7, 8 hours of maintaining price at these levels. But what you've got to think about then is with the market trading back down away from this area, sellers have regained control. As a result, rather than waiting to sell here, which is what people are usually going to be looking for, and particularly if you're looking at this from a daily perspective, because from a daily, that's the high. That's the only level you can see on a daily candle. But look at it from an hourly point, you can see where the change came. And as such, you can use this level as your resistance to play back down. And once the move comes back down, and we do have another go lower, where does your support come in? It doesn't come in at the low, which is what many people are going to be looking for and thinking, oh yeah, I'll buy it when it gets down here. Instead, it comes in as you retest the point where the balance of power shifted. That's what's so crucial to understand, where that shift happens. Balance of power shifted there, that's where buyers are going to come back in. Buyers come back, and this produces then, you'll bounce back in towards the middle of range. As a result of this, this could now indicate that actually, next time you reach these lows, you may actually have a situation where this is more likely to break than it is to hold. Reason being, if buyers took control here and buyers maintain control here, they are quite likely to give up as the market starts to drop before you reach that previous low. And as a result, you're going to be lacking buyers as we come down here rather than finding more, which is what can then push the market through that level. This doesn't have to be hourly charts. This is how you get these kind of wicks on a candle created. This is a very short-term switch level. Sell-off comes, this is the market that has gone from, this is the DAX, market that has gone from very, very stable, very steady, moving higher, to volatility picking up, much larger ranges coming in day after day here. And then you get big sell-off. So you've got this pickup in volatility, but we're still in a very bullish market. Now, to create these kind of tails, wicks on candles, what's happened within this, and this is on a 5-minute, that's a 60-minute, is that after the sell-off, you again get a market that becomes more balanced. You can see that in the candlesticks. You find there's a resistance, and this comes in at 15,922. Sellers use that as the point where they're going to sell from. They also use it as a place to put their stops behind. Imagine you're short from here. Imagine you're short from somewhere up here and you're now trading all the way down here. You could well be putting your stop just above there. As such, once we break above, the inference is sellers are no longer in control. Buyers have found the point where they can see some value. It was mixed even down here in terms of buyers and sellers. Now buyers have taken control, and as a result, you then get that switch comes back in, support comes in from where previously the market found resistance, and then you get that rally back up. This is that concept of support becoming resistance, resistance becoming support. It doesn't have to be at this point, and more often than not, it's the point where the balance of power shifts from one side to another. Right. Talked about motivation to trade, and let's give a little bit of an example of this. And this is understanding the type of trades that you can take on, the type of trader that you can be. Because just because you have a larger time frame participant who is willing to buy for a longer period of time, looking for more of a move towards the upside, also looking to get in across more prices, doesn't stop you from taking on smaller situational trades. So let's go and look at this from a short time frame participant's point of view. This is an hourly chart, this is an S&P. Short time frame trader's point of view, this is a market that has moved higher. We've then balanced out. You're waiting for shift from here. Either you're going to get buyers push us towards the upside, or you get sellers come in, break this support. Now, once the support breaks, short time frame traders are going to look at this as an opportunity to sell below support, take the quick move down towards previous support, and exit the trade. There's no need to be expecting more than this. And this is about maintaining perspective. Short time frame, that's around about 30 handle move, nice quick movement, under an hour and a bit to get all the way down there, and you get this drop. But this is then what brings in longer time frame participants. Now, contextually at this point, this is the S&P in November 2021, a year ahead of myself. This is the S&P in November 2021. It's in a very, very bullish situation. As such, any dip, buyers are going to start coming in. So you run down to support. We find buying comes in straight on the support at 27 to 17 area. And what you've got to remember here is larger time frame participants want liquidity as well. They need enough people selling to them to be able to buy. If you've got to buy 10,000 S&P contracts, you need people to come and sell it to you, because trying to buy that many is going to drive the market up. So price drops down. Now, short time frame participants can then play the reaction trade off here as well. Larger time frame is going to use this area to continue to buy. If this is maintaining a bullish outlook from the market, then this is where you're going to get larger time frames going to continue to buy. Short time frame traders are going to be much less interested. They're either going to be playing more sort of scalp trades in here, short time frame up, down type trades, or waiting for, like we saw here, a movement away from this range. You get the move to the upside. And what happens here then is essentially continuation sellers get forced out. So those short time frame traders who are trying to play for the continuation, for this to be a drop, bounce, continue, get pushed out. Market drives up, new buyers enter. So you'll have the buyers down here. You'll have the buyers who buy it looking at this as now higher support, and then new buyers who are waiting for confirmation later on. They come in and enter as well. This is what gives you that next leg towards the upside. And this is what then keeps that move going back up, and eventually one will be looking for back towards record highs, which it managed to do over the next couple of days. So make sure that you're thinking about people's motivation and how they want to try and get trades done. Large participants are going to use entire areas to buy. And so until you see a change in what's going on, an example of this would be this drops, bounces, and then you get another leg down, takes out here, then you can be looking at a change. Until that point, this is merely a short-term drop that can be taken advantage of from short-term traders, but isn't materializing into a much larger move. Right then, how do you know if a level is strong or weak? The simple adage that often gets used is levels are strongest on their first touch, i.e. the first time you hit a level, they're strongest. And there is some sense in this. It makes sense. Because when a level is first created, there is shift of sellers coming in. So we know where the sellers came in. Take this example here. Sellers took control there. Now, the next time we go there, we know what happened. So as long as you see the same type of participation, you would expect the same again. Sellers to maintain strength at this same point. That's where sellers got the result that they wanted to last time when they sold here. They're going to come in and see this as a good price to sell again. But the more times you go there, the weaker this level becomes. And this, I think, is often slightly counterintuitive. Because the assumption is, well, if it consistently holds, this is a really good sign of strength. But I would look at this and think about it like hitting a wall with a hammer. Just because the wall doesn't fall down immediately doesn't mean that the wall is stronger. It in fact implies that the wall is now weaker. The more times you hit it, the more likely it is to fall over. So a level in the same way, tested multiple times, is becoming progressively weak. The reason is that each time you go there, you will get people sell the first time. You will get people sell the second time. And it's not about whether they've sold or not. It's about whether they've got out. Because these people who've sold once, twice, now 3 times, 4 times, 5 times, and it doesn't have to be a certain number of times. But if they've not got out of their trade, they're now, and think about this from your own point of view, they're now becoming increasingly frustrated. They've been selling and they're getting nothing for it. As a result, you've also effectively used up the inventory of people willing to sell. Who else is going to sell when everybody is already short? As a result, now you have a situation where not only have you got buyers who may be willing to buy through the level, but you've also got lots and lots of sellers all hoping this goes down. And if it doesn't, they're all going to buy as well. So you now, the more times the level gets hit, in a situation where you're actually running out of people who are able to sell, because for these people who are already short, they need somebody to come in and sell it as the market drops. Now, it won't be them because they've already sold. And as a result, they're now effectively the reason why the level will break on them. So the more time a level gets tested, the weaker and weaker it becomes. This allows you to then approach a level and think to yourself, I'm actually going to buy this. I don't want to sell this level. Or at least you go into the level thinking to yourself, if we get there and we've got pace, I'm buying it. Without pace, I don't want to be part of this. So, quick little example. What we've got here, first test of a level. Now, the important thing to remember is once you get the first test of a level, this still needs to materialize into a movement to bring more buyers in. So think about the kind of auctioning process that's going on here. Okay, so we're going to look at the first time a level is tested. Now, what's so key about this is that it's easy to say, oh, well, yeah, look, it reacts. But what you've got to be thinking about here is it's not just as simple as doesn't it react? Because this could quite easily be a situation where we fall onto this level and trade it sideways like that. That would weaken the level. So it's not just the reaction from the level. That's what gets you in the trade. So if you're looking to take this on the first time, you're looking at this level, which is created on a break of previous lows, through 92 down towards 72. You get the break of previous low. You're looking to buy this. Buyers take control here. Buyers retain control here. And this is what it looks like on a 5-minute chart. So we do spend a little bit of time down there on a 5-minute. And this is where the sort of balance is coming in again. Sellers come down. Once more, buyers retain that strength. They push back, push back, push back. You get a mini switch that comes in just here. And then the key to this is to break above 167.92. Once you get above 167.92, this is where the reaction to the level is confirmed. And that's so crucial. So if you're looking at taking a trade on like this is a really important thing to remember, that it's not just about buying it the first time is when it's strongest, but you need it to then go and break another point. Otherwise, until we get back above the previous lows that were 92, this could well be a pullback. This could well be the balance for another leg to the downside. And that's a crucial thing to remember. So all through this area, if you've bought down here, you've got 2 choices on a trade. You can play this as a first reaction and back to the last reference point, 92. Remember, you're essentially playing an hourly chart, an hourly level. Or once you get above 92, now you can say that the market has changed direction. So it's about what you're trying to infer from the level. First reaction is good. But what you've got to remember here is first reaction in some cases is merely going to be a first reaction before a second and a third and a break, rather than in this situation, first reaction gives you the bounce back to the level for a scalp type trade of 26. And then once broken, now you can look at that and say, we have actually confirmed the turn. You confirm the use of that level to give this larger move towards the upside. Now to flip this over, multiple tests of levels do not offer the same. And particularly when the multiple tests of levels do not create a directional move away from the levels. This is an example using the euro, again, on an hourly or from an hourly perspective. What's essentially happening at these points is the market's being stopped. Now, if you think about this from an auctioning perspective, you would not expect the market to stop at the same point. You would expect that once a high price has been found, the market then, if price does rise once more, people will come in and be willing to pay a higher price. The benchmark has been found for that item. But instead, what this is indicating is that sellers are continually willing to come and sell at those same prices again. This is not what we talked about at the very beginning, where you've seen a balance shift, where actually sellers are now having to sell lower prices. Instead, you're seeing sellers are still willing to sell to buyers at the same price. Now, one of those people are wrong. Because if you've still got buyers coming in, as a seller, you should be thinking, I should raise my prices here, not I should keep my prices nice and low. As a result, and what this shows is that the inability of the market to drop is effectively now trapping shorts. You get lots of people who are willing to sell here. Now, as soon as they step out of the way, the market is then going to break. And that's what gives this move up, because not only have you run out of people selling, because they've all done their selling here and here and here, but now you've also got a situation where those people who are selling are now wrong and they add to the buying, giving you these quicker moves through these poor highs or through these sort of multiple highs, weakening highs. That's why I call them poor highs. Highs that have become weakened and so therefore cannot be viewed in the same way as you would view a level on a first touch like we previously looked at, because of the fact that they have been tested so many times and therefore are not able to create that level of resistance that you would normally be looking for. Okay, interaction at levels then. Now, what's so important with a level is understanding how the market reaches it and what happens at the level. And there's a few different things that can happen. And I'll talk about the ball example in a moment. Now, what is typically, again, spouted as the kind of, this is how to look at level, that if it's fast to the level, you get a better reaction. And this is that kind of concept of sort of standing in front of a speeding train. That it's not comfortable, you don't like that feeling, but that's the time when you're going to get the best reaction. And there is some degree of sense here. And I'll try and explain this a slightly different way in a moment. So speed does matter, but the speed's not really the point here. It's about relative acceleration or deceleration. It's not absolute speed. It's about the change in speed. That's the bit that matters. Because that's going to tell you what the reaction is going to be like. Now remember, any level is a point to make a decision at. And the way that you approach it influences the decision that people are going to make. If you're going to move quickly to a level, what you've got to think here is that once you get there, because people have, let's say, been short to a level, market moves there nice and quick, what are you thinking? You're thinking, brilliant, I can take profit here. And that then flips the balance, because you've gone from being short to now very inclined to get out of the trade because of the speed with which it's approached a level. This creates a kind of fast bounce type move, like a ball bouncing on concrete. Because as it drops quickly to it, people see that and they think, okay, I can take my profit here. That then flips a load of short people to buyers, creates this very short term, at least short term, and potentially longer term, bounce. So there is an element of sense that the faster you reach a level, the quicker the bounce. But what you've got to think about is what exactly is happening there. As you reach a level quickly, if you think about a ball, I'm not going to go into the physics of this because not everyone likes physics. If you think about a ball, as this falls, the speed of the move to the downside evaporates very quickly. As soon as you hit, and let's assume this is a concrete floor, as soon as you hit the floor, that speed evaporates instantly. All of that energy gets transferred into the floor, essentially, which then gives a counter push back. What that is analogous to is that fast speed, sellers coming in, they sell nice and quickly, and they give up very, very quickly. They run into a wall of buyers. Now, it is partly a wall of buyers, but it's also the fact that there are suddenly no sellers. People are not able to get in if the market moves so quickly. So you run out of sellers. And as soon as you then have run out of sellers, bearing in mind that as this starts to bounce, all of these sellers didn't get in. So you don't have these sellers. Now you've got buyers who are trying to buy as the market moves off the low. And they're chasing this up, which is what creates this faster reaction we move up. Whereas you can have an alternative. You have a slow move to a level. And what I mean by this is you have this kind of steady movement and then the market slowly shifts. You run out of sellers slowly. More and more buyers then start to come in and buy. Then eventually that twist or that shift of power comes back the other way. This would be like a ball bouncing on a mattress or on a pillow. It doesn't instantly react. It will sort of squeeze into it and then bounce away. So it will still give a bounce. And I'm not looking here at the size of bounce and the speed of move dictating the size of bounce. I'm talking more about the reaction, the speed with which it bounces. This doesn't tell you anything about how high it's going to bounce. So don't assume that a slow move necessarily has to result in a limited bounce. It's just that the bounce is going to be slower in the pace with which it comes back up. Where you will not get a bounce is a situation where you don't get any relative acceleration or deceleration. So where you have sellers consistently sell and they sell and they sell and you reach a level and they sell and they sell and they sell and there's no change in pace at all. That's where you don't get a reaction to a level. That's what's so important. It's about that shift, and that shift, even when the market is quick, doesn't seem obvious. But if you think about what has actually happened, as a ball drops directionally, you get a change. It slows down in an instant as it hits the floor, and then it accelerates away from the floor as well. That's what's happening when you get market moves quick. If you don't get any change, the market will then continue to just drive itself lower. And that's what happens when you get levels that just break and break and break. You need to see the market change in the way it trades. So when we look at order flow, that becomes much, much easier to see. Once you've had this situation, these are where levels can then become pivots. Market remembers these. And often you will see this, particularly after a directional move, the quick bounce back is then the point that then becomes a sort of pivot within a wider range after that directional move. So I'm going to look at an example of the progression of a fast move, creating a pivot, and then the difference between that and a slower move. In this example, using the pound. What we're looking at here then, and this is the creation of the level initially on an hourly chart. So you get this very, very large move towards the downside. This is where the level gets created at 130, 147. We've had a drop and a pullback. So there's your pullback to the level. Now, when you're looking at this level in future, as we come up here, this move is created here on a 1 minute chart. So there's a 60, there's a 1 minute. Quick move on a 1 minute chart. You look at the size of candles. So I'm using the size of candles to illustrate the speed of movement here. You look at the size of these candles, they're all sitting there. You've got around about an hour and a hour's worth of trade there in around about 10 tick range. Then you get one candle just here that gives you a sudden 40 tick move. Now it's the speed of that move, that change in people's willingness to act, that creates the move up straight into the level. Now, if you've been sitting there watching nothing happen for an hour and suddenly you ping up to a level, you've been long. You're going to see this as the opportunity to get out of the trade. Equally though, people who are not long are not going to suddenly see this as an opportunity to buy. If they wanted to buy it down here and it's now all the way up here, you're going to run out of sellers very, very, very quickly because nobody's going to chase that. As such, you get the reaction. You get this quick move back down. You get this ping straight the way back. So following an hour of being in a 10 tick range, you then get 40 ticks up, 40 ticks back down, 20 ticks back up, and then slowly and steadily the market settles down once more. It gets shaken up. When the market gets shaken up, you get these quicker reactions of levels. So that's the speed element. It's this relative pickup in speed followed by immediate pushback. And it's quite simply that you run out of people willing to suddenly pay much, much higher prices. Price shifts immediately or very quickly. People run out of willingness to keep on trading at those prices. That level then becomes a bit of a pivot area. And you see, this was the creation of the level that we just looked at. And after that, and this is why I don't just get rid of levels, that once we then start trading in a sideways range over the next couple of weeks, we then use, and the market has effectively a memory of these levels, and the market will then come back and use this level again. Now, this is a great example of why you don't just assume that a level is a support or resistance every time it gets hit. Because yes, on the red arrows, we get a reaction. But equally, we trade through it. We trade through it. And again, this is where you don't get reaction. This is where, if you just assume that whenever you reach the level from above, it's going to be supportive, and whenever you reach it from below, it's going to be resistive, you get yourself in trouble, because ultimately we're trading in a wider range. And so it's a level within a range. This is a level that I would use as a target. Now, the whole idea of a target, we'll talk about this when we do entries and exits, is that this is a reference point. This is the point to be aiming for. So you use this as a target. And yes, let's say you bought it down here on what is an area where we've got another mini pivot. You bought it down here, back up to the level, you get out and the market goes higher. There's no point or need to worry about what happens afterwards. What you're trying to do is play to the point where you think there's a reasonable chance this market could stop. Because if you've done that down here and played it back up in that way, you'd be very happy with that result. And that's the whole point. If you're using a pivot level, they're better to be used as a target for a move back to than using it as a point of reference to actually play away from. Now, we're going to look at a situation where you have a market with no speed. Now, this doesn't mean it's very, very slow in its movement. But what it means is this is a market that doesn't change speed. So perhaps speed is the wrong word, and it should actually be velocity. Because velocity implies direction with speed as well. And what's happening here is this never changes. The selling remains consistent. When we do order flow, you guys can go and have a look at this and have a go at trading this. The way it trades and the way it moves stays consistent. This then is a market that approaches levels, and each of these little blue lines here come in 42, 44. You can see, you would look at that and think, yep, that looks like support. No reaction. You just move straight the way through the level. Little reaction on the way back, it becomes a resistance. But on the way down, absolutely no support there at all, despite the fact that you could argue that looks like a pretty solid support area. And the market then continues on its way towards the downside. You get further area of support, which you could draw here. No reaction again. You see it drops onto the level. And when I say no reaction, yes, you do get a bounce of around about 5 or 6 ticks, but the market doesn't change. You look at the way these candles are constructed. If you hadn't drawn a level there, you would see that as just part of a wider move towards the downside. So again, nothing's changing in the way it's moving. It's just relentlessly pushing through levels. The only point you get seemingly some degree of reaction is when you get all the way down towards sort of 41, 46, which is this previous high and then area where we've never managed to fully trade through. But finally, you do get a small reaction, and even that is only 20 ticks before again another push through the level. This is what you get when you have a market that isn't changing the way it trades, that consistently drops. You just get this steady sell, 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 and this is what enables it to just continually push through levels. So whenever you're seeing a market approaching an area of support, an area of resistance, think about the way it's trading. Think about how it's got there, because that's going to help you make a decision about how you expect the market to trade away from this level. Now, like what I said at the beginning, you need the decision made before, and absolutely you do. So if your decision was, I'm going to buy that support, 42.22, then that's your decision. But it doesn't mean you have to buy. What it means is your decision is, I'm going to buy or I'm not. It's not I'm going to buy or I'm going to sell. It's I'm going to buy or I'm not. And so when you get here, you see that the market has absolutely not changed in the way it's moving. In which case you say, this isn't for me. I'm not going to buy it. You let it go, goes through the level, and that way you've differentiated the level and enabled yourself to step away from a losing trade. It's not about trying to be on both sides of the trade. It's about being able to look at that and say, I don't need to be part of this because of the way it's got there. With these little pivot areas as well, remember a market is going to rotate around them. So don't dismiss the fact that you will get these little zones where you can keep on playing it in little ranges. And this is that fractal nature of markets again. This is over multiple days on an hourly. But within this, you will have a whole day that consistently reacts from the level. And again, you get a couple more reactions. Same again here. You then start seeing reactions as a support. So it's about looking at that pivot level and seeing those reactions and playing to the level. You know, your bigger opportunity is going to be buying once you find where the bottom of this little range is. And realistically, I'd actually argue that that's the bottom of the range, not these two little spikes. Playing from the top of the range where you see resistance, 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 you can play it back down towards that pivot level. That's how I'm looking at them, to create mini ranges within a wider range. Okay, the less obvious supports, resistances. These are your initiation candles. Now, talked to you a lot about this and thinking about support and resistance in terms of where control shifted. And this is exactly that. What we're looking at here then, points where a move has been initiated. Now we're not going to do lots on volume, we'll do volume in future sessions. But one of the key aspects of being able to look at a candle and define whether it is a point where initiative has come in is volume. Because that shows that the participation has increased. Now, the obvious, easy way of looking at this is you can look for a large solid body candle. And that's the other key hallmark of an initiation candle. So you're looking for a candle that has a larger body than candles around it, previous candles. So here, nice clear movement, nice clear movement. But you're also looking for up on these candles as well. And that's what's so crucial on these. And what you've got to be thinking about, or what's happening here, is something changes. Now, whether that is news, whether that is a participant comes in and decides, yep, there is scope for this movement and starts to initiate a position. And bear in mind, somebody could be given an order at the bank or hedge fund they work for that says, right, you need to buy, in this instance, Buxel futures, you need to buy them, get on with it now. And that's what creates a move like this, for example. It could well be news. And this is a change in a piece of news, which gives a clear move up, as everybody now sees that there's a strong reason to buy this market. But the point being here, this is where a move has been initiated. As such, this point is remembered. People are going to look at this and think, well, that's where the buyers took control. And so if you want to buy, this is the reference point that you're after. Market's going to come back there. Residual buyers, essentially, are going to look at this and think, well, that was the point where things changed. This is the point where I can act again. And so once you, and particularly in a situation like this, and this is perhaps one of the best example of it, particularly where you have support created higher up. Remember, this is now showing that buyers are willing to move their bids up. Sellers can't push that back down on them. But seeing as buyers completely took control here, if you are a buyer and we break through the area where buyers now have assumed control, you are going to step out of the way. And as a result, you may well lack buyers throughout this bit of the move. Whips down, and that then gives the opportunity to buy. So on that whip down, you can then come in and buy at that point where buyers were in control previously. And you're looking here for quick reaction back up. Back towards previous resistance, you're looking for some degree of reaction. It's not a trade that you're necessarily looking to turn the entire movement. But you're looking at that point where previous movement was created. The assumption is movement will be created there again. As a result, once you get that flip back up, that's then the point where you're looking for an exit on this trade. So more of a scalp type level than a level that would initiate or indicate a complete change of situation. The first move is the one where you're looking for the change in situation. After that, it's much more a case of looking for reaction to these points. Similar example again. This is another one using the pound as an example. I find this is slightly more common with buying candles as opposed to selling candles. This is more something that has been noticed and observed over time as opposed to being something that necessarily has to have too much reasoning behind it. These moves seem to be much clearer, and it could well be the fact that more trades are initiated long than they are short. But what you're getting is a situation here where you do get this drive up and again, reaction. This illustrates the idea that it's not always about a complete bounce or complete move. Each of these creates a reaction from that initiation point, but not a great deal of movement necessarily. And that's the important thing to remember. Like we looked at with that one where you got the first touch of a level, you need to see the reaction, then break another point to then indicate that the move has changed. That's the key to anything like this. On a first touch, particularly if you're trying to enter or take a trade on at the level, at the point of change, you then need to see a further leg to this move before you can then be confident that it has actually changed direction fully and isn't then a reactive move as we've got in these situations just here. So not wanting to try and illustrate, oh yeah, it works every time, just buy these candles and you'll get a big move. It's about looking at that from the point of view. This is a point to react from, can give you precise entry, but you then need more to happen before you can be confident that this is actually a turn. Right then, the big question that is always going to be there with levels is, when is it broken? How do you know that the level has broken? Well, you can try and define this in multiple ways. You could do it by a number of ticks. So you could look at a level and say, right, I'm going to say that once it's gone X number of ticks through the level, it's broken. Now, there is a degree of balance that you can draw here, and you have to then use this per market. More volatile markets will have more variance around a level. Look at something like DAX or gold, the amount of movement around a level is going to be much greater than you will get in a T-bill, for example, or Euro stocks. So you can use number of ticks, for an example, or as a way of doing it. But that also is going to vary by time frame as well. Larger time frame will also have a larger variance number of ticks around that level. The other way that people look at a level being broken is time frame, and suggest that until that time frame or the time frame you're trading on has closed beyond the level is not yet broken. And absolutely, that's true. But what this doesn't serve you very well for is then seeing the market break a level, continue to move in that direction. So let's say you've sold a level, the market has gone through it and continued, and you've still got 45 minutes till that hourly candle closes. Whilst, yes, it may well not close beyond the level, you also don't know how far beyond the level it's going to go before it does close. And that then leads to a dangerous situation of you being a significant distance offside, still stubbornly saying, well, it's not yet closed above the level, despite the fact that it becomes very clear that it is not likely to close back below the level. So the problem with that is ultimately, it doesn't take into account when level breaks or what happens once it's gone through the level. It opens you up to an indefinable amount of risk. At least by having a number of ticks, you can, to a degree, define the level of risk that you're taking on this trade. Now, we all know the old adage that once broken, it flips from support to resistance. And this is key, but not in this basic simple idea of, oh, well, it was support, it's now resistance, it was resistance, it's now support. But in understanding that once a level breaks, until it can then show that it has now created a support out of a resistance, or broken, created a new resistance and broken that, you can't be confident that this is fully broken. So I illustrate this when we look at false breaks, the implications of a false break, and how these things come about. So in terms of considering a true versus false break, left you've got what I call a true break. Now, think about the break from the point of view of what you see initially. Because if you take the move from this point here, these two moves are exactly the same. And you would look at that and say, well, that's a break, that's a break. Assuming they're the same number of ticks, it's a break. Now, for it to be a true break, and this is often something that I get asked about, how do you know if it's a false break or not? How do you know if it's a pullback or not? And ultimately, you don't. Order flow is going to give you an indication as to a false break before it may well have happened. But ultimately, you can't tell, as this is going higher, whether this is to be a true or a false break. The only way that you can tell is once you get a confirmation. A confirmation of a true break is that once this high is created, we pull back and then break it again. So, created, broken. That's a true break. Up until this point here, this could be a move that makes a new high and does that. False break. In the short term, it has broken, it has given you a move, but it has not sustained it. False break, market goes higher, fails to then take out this high and rolls back down. Often at that point then, you will use the old level as continued resistance. The market has not been able to sustain a movement above it. And this again comes back to the idea that markets are fractal. So if we go and look here, what we've got here then is a 1 minute chart of the euro and an hourly chart of the euro. And what we're looking at is this move up. The market drives higher. You may well have got long. That's on this move here. And the passive entry that I've just pointed out here is the retest of this high. So in terms of a break of level, very easy to argue that this high here has been broken. Market moves through it. That's the level at 09.95. Market moves through, pulls back, level becomes support, confirmed support once you break this high here. And that also is a break of this hourly high. So you can be looking at this thinking, yep, this is a pretty solid move towards the upside. Now, you break the next high. That comes in at 12.5. And we then start to find a support area on a 1 minute at 17.5. Now, from the perspective of time frame, this closes above. You look at this green candle here, very clear hourly close above the level. Broken. Look at it in terms of number of ticks. Gone through the level by around about 20 ticks. From a euro perspective, that's a pretty decent sized movement. That would be at least sort of 20% of a typical day's range, at least. You would argue that from a number of ticks, it's broken. So on that basis, this is a bullish market. But bear in mind the fact that you don't then see any continued break of this level. which effectively now becomes a level in its own right. And as such, you can now be open to the possibility that a break back below 17 can actually now initiate a move to the downside. Because what's happened here is that with the break of the level, and think about what's happening and who's participating, the high at 12.5 has been broken. We then have 3 hours of buying, of people continuing to buy up at in these areas here. This creates a building up a position, but no continued movement. And so yes, candlestick wise, numbers of ticks, time frame close, it has broken, but it has not confirmed the break by continuing the move. And as such, it's still always vulnerable to the market then falling over. And this is always the difficulty between fully defining a true and a false break. So looking at a much quicker version of this, and this would be a perfect example of a false break. This is in fact done on a 1 minute chart, this move, and this is an hourly level. So there's your level. This is a level in gold, which effectively gets weakened. The market goes up, tests the level, reacts to the level. Once the market breaks though, and this again is where numbers of ticks can be difficult and where the way the move happens is what dictates whether this is a true or false break. We break this level. The level's 98. It jumps up to 06. That's an 80 tick jump. That's a pretty big move, even for gold. So you get an 80 tick jump through the level, which immediately closes back below the level. The speed of that move, the instant up and back, implies that this was merely buying to exit short positions. People are trapped, people are short. As the market ticks up, they run for the exit. They buy. Once they're out, there's no continuation of movement. And we come back and close on the level again. This then is a false break. The level's not been invalidated. You've had no continued movement through this. It's an instant up, down. Completely different story to that one that we just previously looked in the euro, where 3 hours later, you then got the reversal back down. Whereas here, this is an instant up, instant back. The level has not been broken effectively. Yes, in the moment it will have. Yes, if you're short, you will get stopped out here. And that will happen. But the fact that it can't stay above there is what then suggests that you can now sell it for the move back down. And that gives you a move all the way back down here. It's about understanding the way the level breaks. The fact that this is a weakened level anyway, by the fact that it's been tested multiple times, it's certainly tested twice and then nearly tested again in the morning, suggests that you are going to get sellers forced out. So you wouldn't necessarily want to be short here, which would save that getting caught on the move up. But once it moves up and goes straight back below the level, that's where you can now think, yes, I do want to be short, because the ability of this to keep going has completely failed. Look at a slightly different version. And this again is looking at it from a different time frame perspective. On an hourly, you can see a very clear level here. This again is another example in gold, a steadier move. What we then get is a drive through the level. The level comes in here, the sort of pale green line, so 48.6. This brings new buyers in. Market drives higher, and then you get a situation where buyers will then move their bids up and start to accumulate at higher prices. Now this, at this point in time, half an hour later, looks like a pretty solid break of level. We've closed above. The market could go up. And if we break out of this little range here and go and break the high, absolutely, this not only is a break of a level, but it's a confirmed break. We've got the next leg of the move. But if that doesn't happen, and instead you fall back below the little box, this now is a situation where the buyers in here are forced out. They become sellers. This gets you back below the 48.6, and this level then gets used again. So the real level here becomes these previous highs, not the high all the way up there at 57. That's the point where we false break. You false break up to it, can't find enough buyers to keep the move going on, and the market then rolls itself over. As a result, the failure to the upside provides a spring. And for those of you like Wyckoff have read anything on that, this effectively creates a spring up that then allows for the move towards the downside. We found out there are no buyers when we break up. So it's now a question of, if we go down, can you find some sellers to create this break towards the downside? So let's go and have a look at the difference between a false and a genuine break. Key characteristics is a kind of summary of these. False breaks lack continuation. So you'll get an initial extreme, which is what we just saw in that gold on as well, an initial extreme and no further movement beyond this. They will then get back above the level that was broken. So this low here, previous daily low, break down, no break of the initial low, back up above, false break. And this then gives a move all the way back up to previous highs. This is the DAX example. With a genuine break, you get a slightly different situation. You get the move, so you get this first break of the previous level, which is still valid, at 16,220, and then a break of the next low as well. What further confirms this is that any movement back to the previous level is resisted, and then you get a continuation. So you get the next leg. This is what confirms a genuine break. Now remember, you've always got to think about this in terms of where the opportunity is. There's sufficient opportunity in playing this move down. There's sufficient opportunity in playing this move down. So it's not to say that there isn't an opportunity there, but your ability to get out of the trade is hard because there's no way of saying, okay, we failed to keep this going until you get on the fail break back above this point here. But that's the real key characteristic. You need the break and you need a new extreme. Once you get that new extreme, that says to you, yes, this move has happened. This move has confirmed a break, and we can now look for continuation to the downside. And that's what's happening here and what's happening on any of these tests back. Whereas here, test back, no reaction on test back, and straight away back up. You needed to see if this was going to be a genuine break the first time, then when we pull back here, this would then go again. And if it doesn't hold that resistance, then it is a false break. So it's looking at the break in terms of a failure to keep going, as opposed to just simply going, well, based on a close, based on number of ticks, this is a false or genuine break. That's the key thing that you need to bear in mind. Talked about previously, levels being zones as well. A level is not just simply one price. A level can be multiple prices. And this is where you've got to think about, one, different time frames, but also put yourself in this position. This is a reasonably short time frame chart. This is a 5-minute chart. Now, this is a break of previous lows. So we've had the previous day's low, the current day's low. So you can see where these reference points are. You've had the low from the morning as well, which creates a series of levels that all are dispersed over a few ticks. These few ticks run from 63 down to 56. So rather than being ultra tight on where your level is, you want to look at this as an area to sell. This is the opportunity then, when you get the breakdown, to find that genuine pullback and resistance. And once you get that, this is then where you have the opportunity to sell. And it's not about selling 56, which is the previous low of day. It's about recognizing where this is likely to stop. And if you think about this and put yourself in the shoes of somebody who wants to sell, this is a situation where if I want to sell, I can argue that 56 is a good place, but I'm going to struggle to argue that selling 63 is a bad idea. So from that perspective, you've got to view this as multiple levels that can be sold. And this is that whole idea that a level is not purely one point. A support or resistance is a zone of prices. Think about what's happened to create this. This has been created by multiple tests of a similar area. And as such, you can use that entire zone, like we looked at with the daily and the 60-minute in one of the very early examples. You're using that zone as a point to sell within. This is where you also need to consider where your stop is. We'll talk about entries, exits, stop placement in a later session. So we're not going to go into this too much, but think about this from the point of view. If you want to sell, that's a valid point to sell. That's a valid point to sell. There's no reason to not think that anywhere in here is a sell. And this then brings to the concept of secondary highs and secondary lows, which is one of the last things I want to talk about when we're looking at supports and resistances. Now, this is something that I learned myself, not immediately, and was often frustrated by buying here on a retest, only to then see a market break down on me. I get stopped out, and then look back a little while later and think, oh, we're trading higher than where I bought it. Why have I lost out on this? And this is a case of, I think one of the things that's important to recognize here is it's a case of recognizing that the obvious level, the obvious trade is not necessarily the one that is going to give you the reaction. The easy thing to do here is to look at this and think, right, okay, there's previous high, we're going to get a bounce from it. And you do the first time. And this also goes into the idea of management of expectations and viewing this range as a range you could trade through, but also not viewing this range as a point to assume that we're going to get this gigantic move. So what we've got here then is what I would call the high and then your secondary high. So this is created before the move up. There's your secondary high. As such, I would not see the change in market coming until you break below here. Somebody who's got a lot to buy is going to buy over all of those prices. Now, if you take this onto a short time frame, this is an hourly, this is your short time frame move. Break of 56, which is this little box here, and it gives you a nice quick drop down onto these secondary highs. This is where the frustration comes. For shorter time frame traders, they will either buy the obvious high and get caught out because we break through, and then they become frustrated when we're trading back up and trading higher. Alternatively, they sell on the break of that previous high, looking for a directional move down, looking for continuation down, only to find a market that drops quickly and bounces back on them. And that's a result of being in an area where ultimately you've not changed direction. You've created movement, yes. And that movement is ultimately the exiting of short time frame traders taking the obvious trade on it. Think about who's doing what. Short time frame traders doing the simple thing of buying the previous high, previous low, create the move down. But in them doing that, and in a few of the short time frame traders playing the break, they create this little bit of movement, which plays into the hands of somebody who still wants to buy and is going to buy across all of these prices, of being able to sit there and think, brilliant, I've got all this liquidity coming in, they're coming to sell to me, I can sit there and buy it from them. That's what's happening here. It's a quick drop down. Some people get stopped out. Some people try and chase the move, expecting more from it than is necessarily there. And you then get this bounce back. So important is management of expectations. Understanding where the opportunity is. And there's nothing wrong with playing this. That's a nice, quick 50, 60 tick move. Where people make the mistake is once in the trade, they don't manage the expectation of this is still running into the slightly less obvious, but very strong secondary high. That's where the market gets trapped and where it gets stuck. And that's where shorts selling, expecting more from this than is necessarily there, get themselves trapped and driven back. And that's what creates this fast up down. So these faster moves, that's a prime way that they can get created. Now that was looking at it as a way of managing expectation. But in the short term, you can then look at this as places to take trades on and take these trades on. And you can take these on as 2 short time frame trades. You don't have to take this on as a much larger trade. You could take it on as 2 short term trades. Initially, you open, this is S&P one. Open, this is, when I say an open, this is open on the overnight session here. We open just above the high, little flick down, onto the previous high, and then bid back up. You then get a second move down into what I would call the real level. So slightly different from the secondary highs that we get here. And I term them in the same way. But you see with the gold one, you have a high and then you have highs formed below here. Similar kind of structure. But instead, what's happened in the S&P is you have a high, a couple of tests at the same level here, false break, no close above, and then we use that same level again. That's what I would call the genuine level. So yes, there's going to be a reaction from the obvious level. If you think about this from a daily candle, your daily candle is going to show that as the high. But the less obvious level, until you get down onto a shorter time frame, looking at it from an hourly or half hourly point of view, is this level slightly lower down, which provides you your secondary high. That provides you the next level of support. You can play these as 2 separate levels, but don't change your view until you break them both. So what I mean then is if this is your first high, you could buy that with a stop just below it. You get out and you can then go and buy the next level down with a stop just below that. Alternatively, if you buy here and you're looking for a larger move to the upside, you can look at that and say to yourself, okay, I'm willing to buy there, but I'm not going to get out until we get below here. So there's a different structure to the way you take the trade on. It's all about thinking more, and when we talk about entries and exits, thinking about what you're trying to get out of this trade as a whole, as opposed to just purely thinking about it from the perspective of buy it because it's a good entry, and then people get out with the same rigid stop. Some situations, getting out with a clear stop just behind the level makes sense. In this situation, If you're looking for a larger continuation move higher, getting out just because you dipped below that first high would not be an adequate reason to exit the trade, because there's still very strong reason to want to buy it all the way down to this point here. We're going to follow on by looking at trend lines, looking at some of the crossovering concepts between trends and support and resistance levels, looking at how to use trend lines, how to use them to define a move, when they break, when they shouldn't break, what to expect when a trend breaks and what to expect if it fails to break, or how to identify a failure of a trend to break, and how the structure of the trend then deviates after that. So that's what's coming up next.